A few months ago, private credit was being marketed to retail investors as the investment of the decade, a way to access the kind of 9 to 12% annual returns that had previously been reserved for pension funds and university endowments, with the added promise of quarterly liquidity windows that made it feel almost as accessible as a mutual fund. That promise is now being tested in the most uncomfortable way possible. Billions of dollars in withdrawal requests are piling up at the industry's biggest names, and investors are discovering that the semi-liquid label on their fund documents carries a great deal more fine print than they were led to believe. According to the Financial Times, retail investors requested more than $10 billion in redemptions from private credit funds in the first quarter of 2026 alone, and that number is expected to grow as more funds report their figures. Blackstone, BlackRock, Blue Owl, Apollo, Morgan Stanley, Ars, and Cliffwater have all moved to cap withdrawals, restrict redemptions, or halt liquidity altogether. For investors who are told they could exit quarterly, the reality of a gated fund is a cold shock. This article explains exactly what happened, why it matters, and what you should do if you are among the affected investors. The scale and breadth of the current liquidity crunch is what makes this episode different from routine volatility. This is not one fund having a bad quarter. It is a sector-wide simultaneous gating event affecting the largest and most trusted names in alternative asset management. Blackstone's private credit fund recorded redemption requests totaling nearly $4 billion, a record 7.9% of its assets, and the firm responded by raising its quarterly redemption cap to 7% and injecting $400 million of its own capital to help manage the pressure. BlackRock's HPS Corporate Lending Fund received $1.2 billion in withdrawal requests, equal to 9.3% of net asset value. The firm paid out only $620 million, meaning investors who wanted out received just over half of what they asked for. Apollo's Debt Solutions Fund received requests exceeding 11% of its shares and enforced a strict 5% cap, returning roughly $730 million of the more than $1.5 billion requested. Morgan Stanley's North Haven Private Income Fund saw requests balloon to over 10% and similarly capped payouts at 5%. And Cliffwater's $33 billion flagship fund faced the most extreme pressure of all. Investors demanded 14% of shares back, and the firm cut that to a 7% limit. Blue Owl went furthest of any. It permanently halted quarterly redemptions from its retail-focused Capital Corporation II and sold $1.4 billion of its direct lending assets to pension funds to generate liquidity. The first and most fundamental cause is structural. Private credit funds sold semi-liquid products to retail investors whose tolerance for illiquidity is fundamentally different from that of institutional investors. Institutional investors, pension funds, endowments, sovereign wealth funds, commit capital for 7 to 10 years and do not panic at the first sign of market stress. Retail investors, even high net worth ones, have shorter time horizons, less diversified portfolios, and a much stronger emotional response to uncertainty. When geopolitical shocks, rising interest rates, and default fears combine, retail investors want out. The quarterly liquidity windows that made private credit accessible to individuals created a structural mismatch that is now blowing up in real time. The second cause is a genuine deterioration in credit quality. Private credit default rates reached 5.8% through January 2026, according to Fitch, the highest level since the index was created. Morgan Stanley has warned that defaults in direct lending could surge to 8%, well above the historical average of 2 to 2.5%. These are not theoretical numbers. Multiple high-profile bankruptcies of private credit-backed businesses have already crystallized losses. Tricolor, an auto lender to low-income Americans, filed for bankruptcy in September 2025. First Brands, an auto parts company, collapsed with $10 billion in liabilities. Carriox Capital, a specialty finance vehicle, failed in October 2025. Each of these events triggered losses and redemption pressure across multiple funds simultaneously. The third cause is AI disruption. Morgan Stanley specifically flagged that sectors vulnerable to artificial intelligence disruption, particularly software companies, represent a disproportionate share of private credit loan portfolios. BlackRock's HPS fund, for instance, has 19% of its portfolio in software sector loans. As AI tools reduce the need for large software workforces and compress the revenue of traditional software businesses, the creditworthiness of these borrowers deteriorates, raising default risk across an enormous slice of the private credit universe. The comparison to 2008 is being made frequently, and it deserves a clear-eyed assessment rather than either dismissal or panic. The similarities are real. An asset class that grew rapidly on the promise of superior returns sold aggressively to investors who did not fully understand the liquidity risks, with valuations that are set by managers rather than by market prices, creating opacity that masks the true magnitude of stress until a crisis forces transparency. The gating of funds, preventing investors from accessing repricing their own money, is precisely the dynamic that preceded the collapse of mortgage-backed securities vehicles in 2007. However, the differences are also significant. Private credit, at $2 trillion in assets, is large but not systemically dominant in the way that mortgage-backed securities were in 2007 when they had infected every corner of the global banking system. Private credit funds are not leveraged to the same degree as the structured vehicles that collapsed in 2008, and the regulatory framework, while imperfect, is more developed than it was before the last crisis. Lloyd Blankfein, former CEO of Goldman Sachs, captured the nuance well. The question is not whether big institutional investors can absorb losses. They can, but what happens when the retail investors who have recently flooded into this market begin experiencing real losses on savings they believed were protected? If you are invested in a private credit fund that has implemented redemption restrictions, it is important to understand exactly what your options are and are not. A redemption cap does not mean you have lost your money. It means your access to it is restricted to the cap percentage per quarter. If you requested a full withdrawal and receive half, the remainder sits in a queue for the following quarter's redemption window, assuming the cap allows for further payouts. This can mean waiting multiple quarters, potentially more than a year, to fully exit a position. The secondary market for private credit interests exists, but is thin and heavily discounted. Firms like Saba Capital have been actively making tender offers. In Blue Owl's case, offering to buy shares at $3.80 per share in cash, a significant discount to net asset value. Accepting a secondary market offer means realizing an immediate loss, but it also means achieving full liquidity now rather than waiting through an uncertain redemption queue. For investors with urgent liquidity needs, a home purchase, a business investment, an emergency, the discount may be worth accepting. While the private credit funds themselves are difficult to price on a daily basis, that is the nature of illiquid assets. The publicly traded stocks of their managers are sending a very clear signal. BlackRock shares are down more than 21% from their 52-week high as of early April 2026, despite the firm managing $14 trillion in assets and generating record fee income. Blue Owl, Blackstone, KKR, and ours have all seen their stocks decline by more than 25% from peak. These are not companies in existential danger. Their balance sheets are strong and their broader businesses continue to perform, but the market is pricing in a meaningful reduction in the private credit fundraising ambitions that have driven much of their valuation premium in recent years. For investors who hold these stocks rather than the private credit funds themselves, the decline represents a different kind of opportunity analysis. The asset managers are being repriced based on the risk that retail capital flows into private credit slow or reverse, reducing their fee income and growth runway. Whether that repricing has gone too far or not far enough depends on how severe the credit quality deterioration ultimately proves and how quickly the sector can restore investor confidence in its liquidity framework. For investors currently in gated private credit funds, the first and most important step is to read your fund documents carefully and understand exactly what your redemption rights are, what the cap percentage is, and what the queue mechanism looks like. Contact your fund manager or financial advisor for a clear written explanation of when and how much you can expect to receive. Do not assume that the marketing materials you received before investing accurately reflect the current redemption mechanics. In several cases, funds have changed their policies under pressure. For investors considering new allocations to private credit, the current environment argues for a pause and a much more rigorous due diligence process than was common during the asset class's rapid growth phase. The questions to ask are, what is the fund's actual liquidity mechanism, and has it ever been stress tested? What percentage of the loan portfolio is in sectors vulnerable to AI disruption? What is the current default rate in the portfolio, and how does it compare to historical averages? Is the valuation of portfolio loans marked to market or set by the manager? And, most critically, how much of the investor base is retail versus institutional, and what does that mean for future redemption pressure? The democratization of private credit was a genuine financial innovation. The idea that retail investors should have access to the same high-yielding alternative assets as institutions is not wrong in principle. What went wrong was the execution. The liquidity terms offered to retail investors were not appropriate for genuinely illiquid underlying assets. The growth of the asset class was too fast for adequate due diligence to be performed on underlying loan quality, and the marketing of these products emphasized return potential while underemphasizing the very real risk of gated withdrawals during stress periods. The current crisis is painful for investors who are stuck waiting for redemptions they were told would be available quarterly. But it is also a necessary correction, a repricing of the genuine risks of illiquid investing that will ultimately make the private credit market more honest and more sustainable. For investors who entered with clear eyes and a genuine long-term horizon, the underlying economics of private credit remain attractive. For those who entered believing they had near-liquid access to institutional grade yields, this is an expensive lesson in reading the fine print. The asset class will survive this episode. Not every investor's confidence in it will.